On this slide, you'll see our topic, building your investment portfolio, asset allocation and strategy. This is all about your investment mix. Before we get too deep, let's quickly recap what we have covered in our last session. Stocks, which are like owning a tiny piece of a company. When the company does well, your price's value will go up. Bonds, which are essentially lending money to a company or a government, and they pay you back with interest. It's like kind of like a bank with hopefully higher interest. And then we have funds and ETFs, which are like baskets of investments. They can hold many different stocks and many different kinds of bonds or a mixture of both. We also talked about how diversification is key. This means not putting all your eggs in one basket, spreading your investments around to reduce risk. Today, we're going to build on these basics. This lesson is about how to combine these different types of investments into one cohesive, powerful strategy that works for you. So, what's exactly an asset allocation? On this slide, you will see an investment pie chart. Asset allocation is simply deciding how to slice up your investment money among different types of investments or asset classes, like stocks, both US and international stocks, bonds, and even cash. For an example, the Ford Fund chart on the slide shows 50% US stocks, 30% international stocks, 15% bonds, and 5% money market. The crucial thing to understand here is that it's not about picking individual winners. We're not trying to find the next hot stock. Instead, it's about picking a broad fund allocation, deciding on the percentages for those big categories like all stocks or all bonds or a combination, and also looking for diversified funds. This is a strategic decision that sets the foundation for your portfolio. Now you might be wondering, why does this pie slicing matter so much? Asset allocation is actually the biggest factor determining your portfolio's long-term return and how much risk you'll be taking. Yes, you hear that right. How you divide your money among asset classes is more impactful for your long-term success than trying to choose the absolute best individual investments. The goal is to match this allocation to your specific situation. Your time horizon, how long until you need the money, and your risk tolerance, how comfortable you are with the ups and downs of the market. Let's explore those factors starting with age. Young investors have a longer time horizon. Because of this, it makes sense for them to have more stocks and fewer bonds. This strategy focuses on growth, as stocks historically offer higher long-term returns. As you get older, your time horizon shortens. The strategy typically shifts. Older investors tend to have fewer stocks and more bonds. The focus here moves from aggressive growth to the preservation of your wealth. The chart on this slide shows an allocation of stocks versus bonds based on your risk tolerance. And you can see we have conservative, moderate, and aggressive. For example, at age 30, you will subtract 110 from 30, and you will have 80% stocks. While age is a good general guideline, it's not the only piece of the puzzle. We also need to consider your personal risk tolerance. ask yourself, how comfortable am I with my investments going down in value in the short term? Because let's be honest, the market has bad days, weeks, and even years. Your comfort levels with those temporary dips matter, even if you have a long-term horizon. Some people are more risk averse than others. The chart that we saw on the previous slide shows us the allocation of stocks versus bonds based on age, but also on different risk tolerances. For an example, you can see we have conservative, moderate, and aggressive. And we have different numbers under each of these categories. We call this the rule of 100, rule of 110. So if you're conservative, what you do is you take your age and subtract it from 100. So for example, if you're 30 years old and you're conservative, you will want 70% in stocks, and the remainder of that would be 30% in bonds. And you can see the difference if you're aggressive. That would be 90 and 10. In summary, your asset allocation will depend on your age and your personal risk tolerance. When you look at the model portfolio for age group chart on the previous slide, you will see how a 30-year-old allocation will change. For example, you got the three risk tolerance categories. Aggressive, they will be in 90% stocks. Moderate, they will be 80% stocks and 20% bonds. And a conservative, you will be in 70% stocks and 30% bonds. You have to determine what is your risk tolerance. And then you could use that chart to get the allocation that's best for you. Now, I know that all this talk about percentages and adjusting allocations might sound a bit complex. But here's some great news. There is a simple hands-off way to manage this. And we briefly discussed it before, and it's called target date funds. These funds automatically manage your asset allocation for you. They start out with a more aggressive mix, more stocks when you are young, and then they automatically and gradually shift to a more conservative mix, more bonds, as your target date approaches gets closer. The way they do this is through something called a guide path. As you get older, the fund's guide path automatically increases its bond allocation, becoming more conservative over time. It's an easy way to implement an age-appropriate strategy without having to constantly monitor and adjust it yourself. The chart on this slide shows the percentages, how it changes over time. For example, if you're 35 years out of retirement, you will have 70 plus 20, you will have 90% stocks, because we're adding US stocks and global stocks. And you can see how that changes and goes down. And also there is a short-term cash fund that will start increasing as you get closer to your retirement age. Even with a great initial asset allocation, or even a target date fund, you need to be aware of something called rebalancing. Over time, your initial investment mix will drift. Market changes causes your actual allocation to shift from your target percentages. For an example, if your stocks had a good year and they went up in value, they might now be 95% of your portfolio instead of your target, which was 80%. Your pie slices change size because some investments perform better than others. Rebalancing simply means bringing your portfolio back to your desired percentages. It's kind of like trimming a bush that grows unevenly so that you return it to its intended shape. And that's what you're doing with your investments. So why bother rebalancing? It might seem like extra work, but it's really important for a couple of key reasons. First, it helps maintain your desired risk level. If your stocks surge and become a much larger percentage of your portfolio, you're now taking on more risk than you initially intended. Rebalancing brings you back to your comfort zone. Second, and this is pretty cool, rebalancing is kind of like a form of buying low and selling high. Relatively speaking, when you rebalance, you essentially are selling some of your assets that have done really well and using that money to buy more of the assets that haven't performed as well. It's a disciplined approach to selling assets that are comparatively expensive and buying those that are comparatively cheaper. This helps you maintain your risk. Now for the practical part. How do you actually rebalance? You could do this periodically, perhaps annually or semi-annual. Don't feel like you need to do it every week or even every month. That's not true. There are two ways to rebalance, two main ways. One, you could sell some assets that are now overweight, meaning they have grown to be larger percentage than your target, and then buy some assets that are underweight, meaning they have shrunk or haven't grown as much. This will directly adjust the percentages. Or if you're still regularly contributing money to your retirement savings, you can direct your new contributions to the underweight assets classes until you reach your target percentage. This is often the simplest and most efficient way for active savers, as you don't even have to sell anything. On the other hand, if you had target date funds, they rebalance automatically through a predetermined strategy that you have selected. This means that the fund's underlying assets allocation, the mix of bonds, stocks, bonds, and sometimes other investments, is adjusted over time without you needing to do anything manually. Okay, let's now bring it all together. What are the key takeaways from this lesson? Remember, asset allocation is key to your investment strategy. It is the foundation upon which your financial growth will be built. Align your investment mix with your age and risk tolerance. For most young adults, this probably means that you're going to get growth-oriented stocks. That's what you're going to be picking, the stocks. And finally, periodically rebalance to stay on track. This ensures your portfolio continues to match your goals and risk comfort. Now for some action steps that you could take. I encourage you to think about deciding your target assessment allocation for your retirement savings based on your age and risk tolerance. Feel free to use that model portfolio chart that's on our site. Or if you prefer a hands-off approach, use target date funds. If you already have a brokerage account, the platform where you're investing, see what investment options are available to you.